Welcome everybody to the Chinchilla Pickin' podcast. It is January 13th, 2025, 9:56 a.m. and the markets are open Monday morning. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood and I am here by myself this week. Brandon is a little under the weather, and I'm here trying to hold it down all by myself. So what I've done in the past is when I've had to do these, I called it a downtime with Dave. I tried to make it the about the length of a break from work, so you could just kind of squeeze this in on a car ride to work or a car ride home, something like that, and get some useful information and maybe my thoughts on the week in the market and what we have coming up. Yeah, it's weird because we're already in January and the markets are not looking good. So my January barometer tool that I use every year is looking like it's going to be a down year so far. I mean, we're only halfway through the month. Everything could turn around by the end of the month. And but everything's so negative because of uncertainty. That's what I keep hearing in all these articles and all these shows I watch. Everything is uncertainty, 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 uncertainty about tariffs, uncertainty about the administration, uncertainty of how this is going to go. There is something to be said about knowing, hey, this administration's in power now, and they're going to definitely do this. That does create that opportunity to buy those things or sell the things that it negatively affects and move forward in that regard. But when there's uncertainty, it causes for high volatility. Now, some people like high volatility, and those are typically traders. But I'm going to cover that sort of later on, in this quick little downtime with Dave here. But I want to move into one area that's been hit with some of this uncertainty, quote unquote, and kind of like question: is there really uncertainty, or is the media making the uncertainty? And I want to look at this a little deeper. So I'm going to talk a little, of course, about oil, right? So if you've listened to the show, you've heard me talk about oil and oil companies a lot. I used to give updates on the rig counts, on you know who was pumping out the most, so on and so forth, all these different things. I kind of quit doing that, but I still look at those things. I still go on to Baker Hughes all the time, use their stats, use other stats, and kind of compile a bigger picture of the oil market as a whole. But I'm going to read to you a few different articles here, and then we'll go into my thoughts after I read some of these articles. Or I'm not going to read; I'm going to summarize it. First article, it's off MT Newswires. It was just this morning, came out. Headline reads: Oil rises to a 5-month high as fresh U.S. sanctions on Russia exports squeeze supply. Right? It's a good headline. The reason why I read you guys the headlines, if you're listening, is so that you can look this article up on your own. You could type in that headline. You can say, "All right, let me read what David's reading here and kind of see if I come to the same viewpoint or not." And if you disagree, let me know. But yeah, so it goes on to talk about the Russian sanctions and what's going to happen. So oil prices rose to a 5-month high early on Friday as traders assess the risk to supply following tightened U.S. sanctions on Russia's oil exports, right? So WTI, or West Texas Intermediate, that's what WTI is, or Brent crude is from Brent North Sea. Those are the two different prices of oil that you buy around the world. But Brent, what WTI was last seen at 77.97 when this article came out, while Brent was up to 80.93. So both of them have moved up. The rise is coming as new sanctions on Russian oil producers Gazprom Neft and Surgutneftegas, as well as their subsidiaries, sanctioned more than 180 vessels. So that's huge. 180 vessels of shipping. That's a massive amount of shipping containers that are now being sanctioned around the world. If these sanctions are able to be put in place, because not every country participates the same, but 180 vessels is a massive amount. What that's going to actually carry out to is the data shows the vessels carried 1.5 million barrels per day of exports. So huge amount to the market if they can, really hold these here. So most of these cargoes were discharged outside of Russia. However, given the nature of the shadow/gray fleet, coupled with the sanctioning of the Gazprom Neft and Surganef gas, which make up about 20% of Russia. The number of barrels potentially affected could be even much higher than the 1.5 million. So I mean, there's a lot coming in here. It even goes in and talk about the Trump government expecting to tighten the sanctions on Iran. So that's gonna raise the price of oil as well. And that's what this article really goes into detail and talks about. Now, let me read a different article that just came out this morning at 6:09 a.m. Same day, totally different article. Let me read this one. It says U.S. oil refiners brace for a tough year as investor sentiment turns negative. So this one's going to go in there saying there's softer fuel demand and worries that President Donald Trump may slap tariffs on imports of crude. So U.S. refiner profits start to fall towards the end of 2023 as new refining capacity came online and margins returned to normal. The following 2 years of bumper profits as refineries crashed in on supply shortages caused by the Russian invasion of Ukraine and a post-pandemic demand. Well, since then, major refiners have fallen this year. On average, analysts have lowered expectations for refiners. Fourth quarter earnings before interest, that's EBITDA, if I could talk, EBITDA, they slashed them by 24%. So this article is basically going to go in here and talk about how it's going to have a bad year because they had 2 years of strong growth. Last year they didn't do as well as they did. A lot of them have come down. Like one that I currently own, rig, I'm Transocean, which I'm going to talk about later. It has come down quite a bit, which is the reason why I bought it and I own it. But following a year of negative revisions, analysts are likely to continue bringing estimates lower in 2025 on the back of a weaker curve. That was from a Jefferies analyst. Shares of Valero slipped more than 6% in 2024. Rival Phillips 66 more than 15%. Marathon Petroleum closed down 8% in 2024. So yes, a lot of the oil companies and oil refiners were down last year. I barely got out of my ExxonMobil position with a very little profit. I think I profited like 1.5%, but I exited because I just didn't see it moving any higher, right? But again, this I saw the weakness. I thought that rig Transocean was oversold. That's why I bought in. Um, Here we go. So weakening demand. So this goes in to say that signs of slowing economic activity in the U.S. and China. So China, yes, I agree with this author on China. There is signs of weakness in China, but not the U.S. The U.S. continues to add jobs, continues to move forward, even though there should not be this forward growth. We should have a pullback at some point in the economy, and we're just not seeing it. So, all signs should point to that. I don't see it though in the data, and that's confusing. So it makes me wonder: is this economy built up on credit, or what is it built up on? Right. So right now, the U.S. is the world's largest exporter of motor gasoline. We supply over 16% of the total global exports, according to U.S. Energy Information Administration. The International Energy Agency increased its 2025 global oil demand growth forecast to 1.1 million barrels per day in December. That's up from 990,000 barrels per day the month before. It said the gains would continue to be led by countries in emerging economies in Asia, which are not strong markets for U.S. refiners. That's where the author is going with this, saying that all the growth in oil usage is in other countries and not in areas where U.S. refiners are selling to or moving their product into, which is why they are making the bearish case on U.S. oil refiners here. Investors are uncertain about the U.S. government policies. Again, uncertainty. Everybody's mentioning this in their earnings calls. I'm seeing this on TV. I'm seeing this in articles everywhere. Uncertainty, uncertainty, uncertainty. I believe there is some certainty out there of what we're going to see when it comes specifically to what this author here to this article is talking about, which is oil and oil refineries. I believe we see some certainty once the Trump administration is in office. I believe right now we have uncertainty because of the current administration is making drastic changes on its way out, and that's causing like, okay, what is the next administration going to do? Are they going to counteract this? Or are they not? That's what's causing the uncertainty. But they're saying margins are going to be weak until we get a clear picture reading in the direction of the economic growth and tariffs from Canada. So it's going to be a challenging environment until then. So everybody wants to know what exactly are the tariffs going to look like and what are they going to be on. So read in that article, it actually gives its case for it to end, and it talks about uncertainty and knowing where things are going to go. So if you believe that the Trump administration is going to come in and actually be, favorable towards oil imports and oil refiners, then you would go ahead and continue to buy these companies now as they're down and suppressed due to uncertainty, quote unquote, and a bad year last year. And then you would make your money back. You make a good return on your money in this year. So that's how I'm looking at this article and what it says. Um, Here's another article again. This one came out this morning at 4:50 a.m. These are all three articles that all came out this today on oil and has something to do with oil. This one's more about the Russia sanctions and going more into it. So I want to talk to you a little bit from a different point of view on here because these are all different authors, all different opinions on this. This one, the headline reads: Russia says new U.S. energy sanctions will destabilize global markets. So a little more Moscow friendly, if you will. The Kremlin said on Monday that the latest rounds of U.S. sanctions on the Russian energy sector risk destabilizing global markets, and Moscow would do everything possible to minimize that impact. This is a Kremlin spokesperson said it is clear that the United States will continue to try to undermine the positions of our companies in non-competitive ways, but we expect that we'll be able to counteract this. At the same time, of course, such decisions cannot but lead to certain destabilization of energy markets in the world. We are very carefully monitoring the consequences and configure the work of our companies in order to minimize the consequence of these illegal decisions. Um, so yeah, it's all about these 183 vessels that have been targeted by U.S. sanctions on Russian oil shippers, and getting the oil moving in one place. What they're pushing for is, and the U.S. did this because the war in Ukraine, they're trying to cut the revenues coming into Russia, so Russia won't be able to afford the war in Ukraine anymore, and that's the kind of the thought behind it here. However, the sanctions have prompted Chinese and Indian refiners, which usually buy from Russia, to seek oil from other places. But also with bans on Iran, they're going to be looking more towards Middle East, other countries, Saudi Arabia, so on and so forth. The Kremlin spokesperson, the last quote on here in the article said, "If you block something in one place and an alternative option appears somewhere else. Therefore, a search will be conducted for work options that will minimize the consequences of the sanctions." He's basically saying you're causing us to be innovative, and we're going to find a way to work around this. Yeah, so this is, you got some bullish news on oil and oil prices is what I read out of all this. There's some bearishness, but it's on the refiners. I still see a need for drilling, and that's why I own Rig. Rig just signed another deal recently for 111 million to use one of their rigs and oil wells drillers out there. And I feel very bullish on that. I feel once they report their earnings, it's going to be a nice jump, and I'm going to have a good return on my money, and I'll get out of it. But you got to hold. You can't expect to have these returns overnight. But that's what I read when I read these articles. So if you guys are reading these articles and you read the same thing I am, let me know. If you feel like you read those three articles and you hear or something different, that's good for me to know. Because you're given a different point of view. This is why I like it when Brandon and I get on here and we actually disagree, because then iron sharpens iron. We're gonna sit here and actually debate something, and we'll hear point of views we didn't think of and be like, I didn't think of that. I like that idea and how you're going at it and approaching it versus how I'm approaching it. It's two different ideas, two different ways of looking at things. And that usually works well. But for me, I'm staying bullish on Rig. That's the one I own. That's the one I'm holding, and I'm going to continue to hold it as I look forward into that. So moving on from that, recently Cooler just dropped below $2 a share. Uh, I know it recently gapped up, and I've been bullish on Cooler before, but now that it's dropped below $2 a share, I would look at it as possible buy right now. at below two. I believe it's going to go back above two once the markets move back into a more positive aspect. Right now, everything across the board, a lot of my watch list is red, except for oil. Oil is the only thing that's not red on my watch list. But yeah, the markets are moving negative right now today. Inflation is number one, word of the day, and what's moving the markets. But I want to talk about like switching gears here into okay, inflation is the word of the day today all over the markets. Markets are negative. Some people look at it like, what are we buying today? How are we going to make money today? And it's like, that's not the way you grow your investment. That's not the way you grow your income. You grow your I've day traded. I've been very, outspoken. Day trading can work, but it doesn't work for over 90% of the people. 90% of the people who try to day trade fail. Day trading is very, very hard to do. It's not something that is easily easily accomplished skill. Something you have to really work towards after years and years of experience, and even then, after years of experience, you tend not to day trade because it's you see the risk in it. I want to go over this article, and I found it on CNBC, and the headline reads on CNBC. You can find this, and this was came out this morning at 9 a.m. An investment experiment let traders see headlines a day in advance, and one out of six of them went broke. That's the headline, right? So you're like, what's going on? That made me want to read it too, right? Um, so it talks about how everybody likes to have a crystal ball, know what's going to happen all the time. So a study from investment firm Elm Wealth put this idea to test 118 adults. 90% of them were in graduate finance or MBA programs already. So in November of 2023, the participants were given $50 and a chance to trade the S&P 500 and 30-year Treasury based off the information on the front page of the Wall Street Journal 36 hours in advance, with dollar figures and asset prices redacted, right? So they just know the headlines, and you have to pick the trade, one way or another. So it featured old headlines from 15 trading days, one per year, from 2008 to 2022. In each case, participants could trade as if they knew the future a day ahead before the news broke. Right. So despite these guys being, MBA or finance, graduate programs and what they were doing, and they knew the headlines in advance, one out of six of them went broke, and the average gain was just 3.2%. So even knowing what the headlines are going to be, they only gained 3.2% of the one that actually gained and made money. Very, very interesting. Is this a very true scientific study? No. Is it the only one? Yes. I mean, there's lots of arguments you can make about this study. But the point that I agree with here that they're trying to make is in the long run, what you should do is buy, hold, and close your eyes. And I like that statement. I agree with that statement. I know everybody's gonna say, but Dave, you day trade. I day trade, yes, but that's a small portion of my account. Majority of my account is I put the money in and I let it work for me. Like Rig, I bought that last year. I haven't day traded it. It's still in the account. It's still invested in Rig. I know what I'm looking for, and I know where I'm looking to sell. Right. Um, Basically, they're calling it a whack a mole when you try to day trade like this off of news. There's no hard and fast rules to the market's functions. What this article goes on to say, uh, it's a very good article. You read the end of it, and it really kind of sums it all up in a good way because it divides it into sections. The last section is how to invest when you don't know the future, right? That's what I like about this article, and it's what's right for most. I'm going to read from it right now. What's right for most retail investors is to participate in the market for the long term by being a passive investor, keeping your costs low, controlling your emotions. 100% agree with that statement. Control your emotions, be disciplined is what I call it. I call it being disciplined, not letting my emotions, not letting the roller coasters of the market determine when I buy and sell. I know when I want to buy and sell, and I did it based off of research and fundamentals, right? These are tried and true, long term, very disciplined ways of going about investing. They're ultimately what work. The challenge is they're often boring. Brandon and I have a friend, Tristan, does a very boring way of investing, but you know what? It works. Diamond hands. You buy it, you hold it, you build your wealth, right? Diversify. Have different companies. Don't put all your eggs in one basket. Make sure you're diversified. Make sure you have it growing in different ways. Um, yeah, and it's a very good article. It goes into about trying to make $1 million in a month. I mean, from 99.99999% of the people, that's just impossible. I'm just going to say it's impossible for majority of all people. You have to try and slowly build your wealth, and you could do it in a few years. You could take yourself from zero, to seven figures in just a few years if you have a balanced um, income of basically living below your means is what I call it. If you're living below your means and you have that ability to put money into your account every month and then invest every month in something you have going on, and buy in phases and sell in phases, so on and so forth. We've talked about all these things. You're going to end up growing and it's going to be great. And, take that balanced approach, be very selective. Don't rush into buying and selling just because something's talked about on the TV today and say, "Oh, I heard this on the radio," or I heard this on TV, or I got an email about this. We should go ahead and buy and sell this. Well, take your time, do your research, man. There should be no rush into these things. And when you're rushing and you're trying to chase that dragon, as I call it, you're majority of the time you're going to lose. Every now and then you might get one right and you think you're the smartest person in the world, but you may have just gotten lucky, and you have to acknowledge that. And if you acknowledge that, then you're going to be better off going on in the future. All right. I hope I've given some insight to oil. I read a few articles about it, talked about the Russian sanctions. There's going to be a loss in production every day right now, as long as the sanctions are imposed. But that's just going to make the cost go up, and that's going to make the U.S. oil companies more valuable, which is why you see them moving higher. I do like rig. But I'm not going to buy or sell based off the news of today. I do, like I said, I do day trade from time to time, but not today. I'm not going to do that today. I'm just going to hold my position, and I'm going to continue to do my research and look for other companies. All right. So as always, we hope we have been entertaining, educational, and uplifting because we want everyone to make money. Thank you.